So speak to me on the drivers that informed this earnings that we saw.
Well, basically, in 2018, we had a very modest performance. Deposits rose by about 54%. Profit after tax, as rightly said, rose by about 47%. A lot of this was on the back of interest income. There was a downturn in interest rates in the markets, and we played on that. We also leveraged on our digital platforms to improve our non-earning assets, fees. All these put together led to the improvements that we recorded in 2018. On the back of that also is the fact that in 2018 we raised Tier 2 capital of about 17 billion from our second tranche of 20 billion, and that improved our capital adequacy ratio from about 14% in 2017 to 18%, which means that we do have more capacity to do more business. And we believe that we will continue to ride on the economy, the improving GDP, the economy, to focus on sectors where we can improve our business.
So we'll get to talk more extensively, I hope, about the digitalization, talking about Alert, which was the rave of the moment in the year 2017 when it was implemented by the bank. And of course, we'll get to talk about the Tier 2 capital. But first, talk us through the operating environment for your bank in the year 2018. What factors would you say the earnings largely responded to?
Well, basically, the operating environment, of course, as you all know, improved. We got out of recession, and back to back, Nigeria improved in terms of GDP. On the back of that, interest rates also came down, and that was a major factor for us. On the back of the interest rates, drop in interest rates, we were able to achieve quite a bit. Apart from the fact that yes, the non-interest fees also improved significantly based on alternate channels that we leveraged on.
So let's look at the non-glossy side of Wema Bank's report for the year 2018. Cost-to-income ratio, although did go down from 89% in 2017 to 84% in 2018. Speak to us of the strategies that you hope to implement to ensure that this comes down in line with industry standard, like you mentioned earlier.
Well, in terms of cost to income, yeah, that has been a major issue, and we've been trying to drive this down. Last year was good. I mean, cost to income, cost of funds went down in the economy, and we rode on that to improve our cost. If you've noticed, our net interest margins improved by about 20%, and we believe we'll continue to ride on that this year. As you also know, 2019, the MPC dropped rates by about 50%. We believe that there will continue to be a downward trend in cost of funds. One other thing we're also doing is the fact that we'll reject our retail strategy, our retail structure, to drive more low-cost funds. And we believe that with this, we'll be able to do a lot more. Now, on the expenditure side, we are coming up with, we are digitizing a lot of our internal processes. We believe that this will foster our costs. And also, we're embarking on exploring renewable energy to power some of our branches. We believe with all this put together, we should be able to drop down the costs. Our guidance for this year is about between 75 and 80%.
Ademola, for the first time in 14 years, Wema Bank finally agrees to pay dividend to shareholders, 3 kobo. That could not have been a rosy journey for you. How patient would you say shareholders were for 14 years to not have been paid dividends?
I would want to commend our shareholders. They have really, they believe so much in the bank, and they've been very patient with us. But of course, we believe that at some point we need to begin to return good value to our shareholders. The bank has gone through quite a lot in the last 14 years. Because as you know, as market information, we went through a crisis between 2006 and 2009, and that led to the central bank taking over the bank and then selling off to new shareholders. And of course, a transformation program was put in place from 2009 to ensure that we pull the bank out of the woods, and the outcome is what we're beginning to see today.
Now, agreeing after 14 years to pay dividend to shareholders, 3 kobo per share, and then also agreeing at the same time to talk about plans to raise capital base and getting an approval from the shareholders. Speak to me on how this works.
Well, basically what we've done is there are two types of capital. It's Tier 1 capital and Tier 2 capital. What we did in 2018 was to go for Tier 2 capital. Tier 2 capital increased our capacity from 14% capital adequacy ratio to 18%. Tier 1 capital, we will consider Tier 1 capital much later in the future, probably in 2020, 2021, depending on how things plan out. But we all know that, the capital market is the top place to approach at this point in time. What we want to do is improve our earnings, improve on the capitalization of the bank before we then go back to our shareholders.
The advent of Alert as part of your digital strategy in 2017 was the talk of the industry at that point. Speak to me on your further plans for digital integration and banking going forward. Well,
Alert has done quite well. We are very proud of it. It's giving the bank the visibility. Our strategy is to create a niche in the digital space while we continue to improve on our commercial and other businesses. For us, the journey is clearly mapped out. We want to move Alert from being just a digital bank. And by the way, a digital bank is a fully digital bank, end to end. You do not need to go to a branch. We want to move it from being just a digital bank to being an ecosystem, a platform ecosystem where we can bring all the value creators and the value consumers together. Then they can do a lot of, it's basically a marketplace that we're going to convert Alert into. And that is also in terms of our digital journey, we're looking at a lot of processes within the banking, within the bank to improve the process efficiency, which at the end of the day we believe will dovetail into better performance for the bank and better returns for shareholders.
Ademola, thank you for your time and thoughts on the show this